So what happens? There's a reason why 10% of the population control 90% of the wealth. There's only so many of these folks around. Would you agree? So what happens when you've already run out of that or are close to? You start adding a little bit more of this and a lot more of this. So now what happens? Something's got to give. Because if you think about it, they've been actually doing this already, right? And it's got an A rating. So maybe if I give you a B or an A minus rating, I'll give you a higher yield. Because it's higher risk, but it's a higher what? Higher reward, right? Higher return. So they start selling these things off. And lastly, then they start creating these much higher yields that primarily consisted of just this and a couple of those other ones. Okay, it's important for you guys to get this because this is how this works. This is how the system works. And as if this wasn't creative enough, some brilliant guy in the investment side said, oh, I've got something that'll take this to the next level. You guys want to guess what that is? Let's turn this into a security. Yes. Now pause for a second and think. Before, even though you had a portfolio of, let's say, $5 million in loans, the average loan to value, let's just say, was 90%, though we know that a lot of them were 110% of loan to value, but 90%. That means that you have 10% equity, theoretically, in all of your loans, plus the credit, plus the payment history of your actual borrowers, or your tenants, if you will. So there's a safety margin there, not to mention you're insured, by the way. But then they said, you know what? What we can actually do is we can take these portfolios that are already insured and have all these ratings, and we can convert it into a stock, and we can trade it on the stock market. And when we trade it on the stock market, the question now is, if you're buying based on the value growth of a stock, how does that affect the fundamentals of the loan to values? I mean, how do you know what value you're buying? I don't know. I still don't know. And the fact is, they know because they're getting paid, right? So it became this big cycle of business and a lot more innovative components to it. And as you guys probably remember in the news, another thing started happening with these. They couldn't do these anymore, right? Because what's happening? People can't afford the payments. So what do they go into now? Pick-up payments. Strategizing to lower. You're not even paying your principal down. You're paying interest-only payments for the first 3 years. Then it converts. They were doing everything they could to keep this going. And inevitably, what do you think happened? That was one of the key pieces. Now, this will make you sick. I'm going to share something with you. This really happened. In my research in 2011, some partners and I bought a development in St. Mary's, Georgia, right next to Jacksonville. Beautiful property on the water, gorgeous. In fact, the last battle of 1812 was fought there. Really, really cool. And when I bought the property, it was, it's 2 marinas. It's a pretty big project, let's just say. Not even 24 hours after buying the property, I get a phone call from Bank of America, of all people. And he's like, I'm an executive of Bank of America. I'm calling you in reference to Cumberland Harbor, and I need to meet with you at the property. So first of all, I'm like, what? I didn't borrow money from you, so what do I need you for? And so I said, what do we need to meet for? And he's like, I have to talk to you. It's urgent. So out of curiosity more than anything, I said, well, I've got to know what's going on here. I show up to this property. I meet with them. And in our discussions, they said, here's the problem. The problem is we have over $50 million in loans right now outstanding in your property. I need to know what you're going to do, where you're going to go, because whether you like it or not, we're partners. And I'm like, wow. So in my discussions, I start asking them a question. I said, well, let me ask you a question. What does it matter to you? If they're debt, you're either going to have to foreclose or you're going to have to just collect the payments as we do our business model. They said, no, I need to know because if people go in default, I need to know if I need to stall the foreclosure until you bring values up so we can start foreclosing. And I'm like, what? How can you do that? Don't you have a fiduciary responsibility to your investors? I mean, don't you have to foreclose if somebody's in default? And he goes, no, son, no. We already wrote it off. No idea what that meant at the time. All I needed from you is give me a projection of how much time it's going to take for you guys to start the marina, finish the rest of the infrastructure, and start going vertical. And do not tell anybody that if they stop making payments, we'll not foreclose until otherwise. That was my first experience with real banking at a high level. Now, does that sound even legal? No. I was in shock. So I called a buddy of mine who's really big in banking, and I said, look, man, I'm completely lost. I told him the story, and he just kind of laughed a little bit. And I said, what is this thing? He said he wrote it off. I don't get it. What do you mean he wrote it off? They have debt. He says, let me explain something to you. He's like, when the market collapsed, and this is you guys are gonna be shocked when you hear this. When the market collapsed, the guys who put this thing together and were doing this, they realized that they are secured by FDIC, right? It's kind of the banks are covered by that insurance. So what the banks do is the banks take the time to make sure that they're strong enough financially so that they don't get cut out by who? FDIC. Because you get on the watch list if you have too many toxic assets, if the loan to values have dropped, and you don't have enough depository accounts. So here's an interesting fact. During the collapse, most of the major lenders, like Bank of America, the Wells Fargos of this world, all of the big institutional groups went on a capital raise spree, selling very interesting preferred shares. Guess to who? Anybody want to guess? Overseas, including hostile countries like Iraq, Iran. They were selling off special shares for one reason, to strengthen their depository accounts for what was about to take place next. What they did, they raised billions of dollars in their depository accounts, and then they hired professional auditing companies to come in and do what? Analyze all of their debt portfolios that they're managing. In that debt portfolio management consolidation, they actually wrote them off as losses. FDIC couldn't take them down. Why? Because they had so many strong deposits. They're still big. So in fact, FDIC was rewarding them for having so much money. They're like, here, buy this small bank. Buy that small bank that's falling apart. So they actually started getting bigger, absorbing smaller banks when they were playing a monopoly game. So guess what happens when you write something as a loss? It's gone from the books, right? But you still have what? You still have the mortgages. You still have the securities, don't you? You're still servicing those payments for those that are paying and those who are not, you're following up with. So the reality is, what happens when they foreclose on an asset that they've already written off and they sell it? What is that now categorized? As a profit. Is that interesting or what? So these banks rode it on the way up and they did what? They're profiting on the way down. That's the reason why so many banks have learned. It took them a while on the residential world how to play this game. But when they figured it out, they started controlling the release of inventory in the marketplace. Why? They don't want to depress markets, but at the same time, they want to what? Stabilize the asset and start bringing up values. So who's controlling the growth? Is that incredible or what? So when the guy told me, we've already written it off, just imagine, $50 million, even if they wrote it off to $10 million, they still have assets that are performing. They still have assets that they can make a profit on. Is that not sick? Yeah. That's the reason why there was an act put in place to stop that. But guess what? There's still ways to do this. And you think that's disgusting? I'm going to share another thing, and I think this should be illegal. And then we'll move on to the next step. All right, so you saw all of this that was going on, right? The investment banks were responsible for raising the capital and selling these assets to the secondary market as everybody knows it, right? They're selling the returns, they're selling the security, they're selling everything. But at the same time, as the market started changing, because it was now a what? A stock. Other companies that somehow knew what was going on, that most likely were these guys, were buying puts, policies to what? Guarantee the loss. So they would make money if it went down. Now, does that not infuriate you? Because I know it upset me big time. These guys are playing at a whole nother level of monopoly. And the truth is, in my opinion, this should be illegal. But the fact is, there's always that rule of the gold. He who has the gold does what? They make all the rules. And that's the way that the system is established. Now,